Welcome to the Explainer. Look, if you've been paying any attention at all to global markets lately, you already know something massive is shifting under our feet. Today, we're unpacking the definitive end of the just-in-time delivery era. The Strait of Hormuz isn't just closed right now. The data is telling us it's functionally being erased from the global supply chain for the foreseeable future. So we're going to explore exactly why holding on to paper oil futures, expecting a return to business as usual, means you are literally playing the wrong game.
Let's kick things off with a brutal number, 20%. One-fifth of the entire world's daily petroleum liquids haven't just been delayed by a couple of days. Because of this ongoing 60-day war, that 20% has been structurally erased from the global supply chain. When we look at this data together, this is absolutely the ultimate short-form pivot for anyone trying to analyze the market today. I mean, think about it. When one-fifth of the world's daily energy flow is trapped offline, we aren't dealing with a simple bottleneck anymore. We're dealing with a permanent structural repricing of physical assets. Now, to understand why this 20% is staying offline, we have to face the geopolitical reality of this diplomatic stalemate. The U.S. administration has flatly rejected proposals to reopen the strait until broader nuclear concerns are met. Analysts are calling this the stuffed pig doctrine. So looking at this impartially, we are staring at a Strait of Hormuz that is functionally offline for the foreseeable future because nuclear negotiations are completely taking precedence over immediate economic relief. Let's be clear, this is not some transient temporary spike in prices. This represents a sustained repricing of global risk, where political leverage is simply prioritized over maritime flow.
And honestly, the data backing this up is just staggering. The Pentagon estimates that an incredible $25 billion has already been spent on operational costs and munitions in just the first 60 days of this Persian Gulf conflict. This massive $25 billion erasure grounds our analysis in hard, undeniable data. It proves we aren't just talking about temporary tensions here. We are witnessing a massive structural deficit in the global market, and it's being backed by immense capital deployment to enforce this new reality.
So here's our roadmap for today. We'll quickly move through the $25 billion erasure, why paper trading is now dead, how to spot true physical scarcity, the retail ETF trap, where institutional money is actually moving, and finally, the commodities supercycle cascade. Let's dive in. Section 1. The $25 billion erasure. Right now, we are operating in what professional analysts are calling the obsolete update. What is that? Well, it's the harsh reality that traditional investment models, ones predicated on highly functional maritime corridors and high paper market liquidity, have fundamentally failed. It's kind of like trying to navigate a brand new city, but you're using a map from the 1990s. In the past, energy investing just blindly assumed the Pax Americana would keep these global choke points open. Now, any investment framework assuming those old rules of maritime safety and immediate market liquidity is going to cost you dearly. The alpha today is found entirely in acknowledging that the old system is broken.
Which brings us right to Section 2. Paper trading is now dead.
You see, under those legacy assumptions, you could freely trade paper futures, assuming they'd eventually converge with physical reality through efficient arbitrage. But here's the catch. Arbitrage only works if you can physically move the oil to close that price gap. Under our obsolete update, we have a total blockade and broken market plumbing. Holding paper oil futures right now is essentially like holding a front row concert ticket for a show that has been totally canceled. Sure, the paper has theoretical value, but the actual plumbing of physical delivery, it's completely broken. If you hold paper, you simply cannot get the barrels to the refinery gate.
Moving on to Section 3, spotting true physical scarcity.
For the professional players out there, the primary technical indicator of this crisis is something called extreme backwardation. Now, normally, future oil is more expensive because, well, you have to pay to store it. But right now, the market is entirely upside down. We are witnessing extreme backwardation in Brent crude. This is an urgent, highly localized shortage signal that completely overrides the standard cost of storing oil. Refiners are so desperate for immediate physical supply that they are paying a massive premium to get it today rather than next month. And when you close a choke point like the Strait, ships have to drastically reroute all the way around the Cape of Good Hope, which adds a brutal 10 to 14 days to a voyage. That dynamic aggressively slashes the effective capacity of the global fleet. Because of that, VLCC, very large crude carrier, day rates have breached an absolutely staggering borderline absurd $423,000 on the Middle East to China route alone. So think about that. That makes shipping stocks, the actual companies moving the physical oil, the absolute truest proxy for physical oil scarcity right now.
That leads us perfectly into Section 4, the retail oil ETF trap. Okay, so here is the brutal truth of the current market. Every day, retail investors see oil prices spiking, right? So they flood millions of dollars into commodity ETFs like USO, hoping to catch the wave. But they immediately suffer from a mathematical trap called rolled yield loss, which is driven by a market condition known as contango. Because these funds track paper futures and not the physical barrels, they must roll their expiring contracts every single month to avoid actually taking physical delivery. This means they are constantly forced to sell cheaper expiring contracts and buy expensive future ones. Over long holding periods, they just bleed out performance. You could be 100% right about the geopolitical crisis, and you will still lose money because you're playing a broken paper game.
Let's look at Section 5, where institutional money moves.
The smart money? They are ignoring the paper futures entirely. Instead of bleeding out in ETFs, institutional capital is quietly but aggressively securing the physical infrastructure that actually moves and stores the world's energy. They're buying up midstream infrastructure companies. Think names like Enbridge and Kinder Morgan. Why? Because these are essentially global toll booths. Their cash flows are volume-driven, they're fiercely protected by long-term contracts, and they have built-in inflation adjustments. They operate on these highly resilient fee-based shipping and handling models. They are the ultimate beneficiaries of a world that desperately needs new, secure supply routes. Finally, Section 6, the commodity supercycle cascade. Erasing the Strait of Hormuz doesn't just impact gas prices. It rips through completely unexpected sectors. For instance, it turns out Qatar supplies a full third of the world's helium. You block that, and suddenly semiconductor chip cooling costs soar in the tech sector. Also, the Middle East is a massive source of sulfur and natural gas feedstocks. You lose that, and global agriculture is instantly crippled by fertilizer shortages, which drives massive food inflation. Even manufacturing suffers as energy-intensive aluminum smelting costs absolutely skyrocket due to severed LNG flows. When you step back and look at these interconnections, it proves beyond a shadow of a doubt that the inflation we are seeing is anything but transitory. So, moving forward, professional analysts are tracking three main scenarios. First, we have a prolonged blockade, where oil could realistically push to $200 a barrel, making midstream infrastructure the clear, undeniable winners. Second, a phased reopening driven by diplomatic pressure, which, to be warned, would trigger a violent unwinding of the current war premium. Or third, a kinetic conflict escalation leading to permanent infrastructure collapse in the region, which would massively benefit the U.S. shale and renewable energy sectors. But regardless of which of these scenarios actually plays out, the era of physical dominance is here to stay, and it's fundamentally raising the structural floor for all of these commodities. The decades of just-in-time delivery and easy energy choke points, they are over. The obsolete update is in full effect. As we look at a world where the global plumbing is visibly broken and 20% of supply is simply erased, it begs a critical question for your own portfolio. In this new reality, are you holding the physical reality, or are you just playing a broken paper game? Thank you for exploring this with me on The Explainer.